So in this module, I'm going to talking about rapid fire strategy for scalpers. So as a scalper, you would be trading high volume and then not worrying about how big the profit is. As long as there's profit, you would be closing the trade and take that small profit. Now, most of the strategies involving scalping, they employ some kind of indicators or price actions or a combination of both. And ideally, you want to go in and out of the trade very quickly in the lowest time possible, so that you can move on to the next trade and you can scalp again. So in this module, I'm going to be talking about the rapid fire strategy, and they were developed for the 1 minute and 5 minute charts, which you can use, and it gives you enough time to come in and out of the trade several times in a day. This strategy can be very exciting, but it can also give you a lot of stress and fatigue, and you can lose focus very quickly because it is fast-paced trading. You are expected or recommended to take frequent breaks or finish trading for that day. If you don't do that, if you're stressed out and you know you're stressed out, there is a high chance of making mistakes, and then this could lead to this is one of the rules you have to set for yourself. I mean, trading is actually, in order to become profitable, it's a slow process, because if new traders think that they can go in a trade and come out quickly, and then if they're not going in the right direction, it's not working, and they make all these decisions, and they want very quick return, which is a very wrong way to approach it. If you approach it in a way that it's a slow return, and then you set a time frame that yes, it's a slow, long process, then your expectations are different. Then there's a high chance that you will learn a lot, and because you are in for the long term. So for example, after trading for 1 hour, you can say you're gonna stop, or if you hit your daily target of profit of 50 pips, you're gonna stop. And that gives you a very good target to meet each day. Over trading is not necessary, and it does not really lead to more profits. And in reality, it can do just the opposite, and it can do harm. So over trading is not recommended. For scalping, you would want to use a very good speed computer and high-speed internet, and coffee or tea, whatever works for you. So the rapid fire strategy has two criterias. So one is most liquid pair, lowest time frame. So these are most liquid pair available and lowest time frame. So this is the rapid fire strategy, and we are going to continue. So you can do this with M1 or M5. This is a 1 minute strategy. So 1 minute chart, you can do the 5-minute chart. So you have to be careful not to get overly excited, and on a particular day, on an average day, you can see about 30 to 40 trading opportunities. So that is a lot of trades. Now the time frames, we've set the time frames, but the pair that you want to trade with at the moment is actually USD and Euro, or Euro USD, whichever you want to do, it's fine. They're both more or less the same. So this is the pair for rapid fire strategy that you want to trade with. You can use the candlestick chart with a 1-minute price movement, and then you can use we will use the indicator, two kinds of indicators in this example, and one is going to be the parabolic SAR, and the second one is going to be SMA, which is simple moving average. So let's look at the first one, the parabolic SAR. So this is also known as the acceleration factor, which is the AF, and it starts at a minimum value of 0.02 and maximum value of 0.2, which means that the AF can reach a max of 0.02, 0.2, no matter how long the uptrend or downtrend extends. So a higher step basically moves the SAR closer to the price action, which makes the reversal more likely. And if the step is set too high, the indicator reverses and it produces a whipsaw. So the parabolic SAR was developed by J. Wilder to find trends in the market prices, and the SAR stands for stop and reverse. So the formula here is SAR I equals SAR I minus 1 plus AF times E price minus SAR I minus 1. So that's the formula which we have for the parabolic SAR stop and reverse. So if we look at the code, what each of these values mean, this would be, I'll copy this here. So the stop and reverse I is value of the indicator of current bar, then we have value of indicator previous bar. And then we have the acceleration factor. This is the acceleration factor, which we know is increased. AF is increased by 0.02 each time a new E price is recorded. And E price is extreme price, which is the highest price reached during the current uptrend or downtrend. So highest trend or lowest price in a downtrend. So as using this strategy, you will utilize this formula to generate a use this formula to generate buy or sell signals. A bullish signal is generated when dots of the parabolic is below the price, causing you to expect upward momentum to continue. And on the other hand, the bearish signal is generated when the dot is above the price, causing you to think that the downward momentum will continue. And this works extremely well when markets are moving in a trend. Okay. The next one is the simple moving average, SMA. Okay, let's look at this one, this rapid fire strategy. So SMA is calculated by adding price of candlestick over a given number of time and then dividing the total sum by the number of periods. So it's simply an average, and we will look at this, how to calculate this. So for example, if we look at the simple moving average for 1 hour, we have 60 minutes. So let's look at the chart. We will use the candlestick by clicking here. We'll use 60 minutes, which is 1 hour, and then we can see that the when I move the cursor, the mouse, you can see the time changes by 1 hour because I've got 1 hour here. So this is 13 November at 19 hours 7 p.m. Then the next one is 20, then 21, and so forth. So what I want to do is, so this is 1 hourly. Let me look at 1 minute one, and this is actually okay. Zoom out. Okay, it's not showing properly the 1 minute chart, so I'll go with this one. So you can use this one. So this is every half hour. You can see it's every half hour. What you do is you will use the closing price of each of the bar for the last 60 times, and then you will divide that by 60, and then you will create a trend with that, and this way you will know which way the price is moving. So of course we're not going to sit here and write down each of the number and then divide. So what this chart has, what you can do is, most of the chart have additional indicator development. So you can click on indicator, and then you can type here an average, and you can see all kind of different averages. So the one we are talking about is moving average. So click on that and close this window, and then when you come here you will see one additional line, which is the moving average calculated for you by this chart. So you can see a huge drop, and then so this is actually a trend, and I can hide it or show it, and you can see that this is the moving average. So even though if the price was up here, we know that the price was really up here, so that means it has room to come down. Let's look at this area here. So when we look at the moving average here, we know that the actual price was up here. If I zoom into this, we know that the price was here, but according to the moving average, the price was actually here. And then at that time, if we don't see, I'll just put a calculator on top. Let's just see. Suppose this is a live chart and I don't know what's coming up. So suppose this is a live chart and I don't know what's coming up, and I'm over here, or I'm somewhere here, halfway through. So this is 3 o'clock, then this is 3:30, at 4 o'clock, at 4:30. So I know between 2:30 and 4 o'clock and 4:30, so this is a 2-hour difference. I know that the moving average trend is going upwards. Even though the price in between, it fell in that half hour between 2:30 to 4:30, it closed here, and I can't see the closing, but wherever it closed here, yes, no, it closed here, yes, and then it opened here, and it closed here, and then opened here, and then closed here. So we know that even though this is going down and this is going up, and this went down, I'm not going to do a down, I'm not going to sell short. I will look at the trend, and according to the trend, this is going upwards. And if I move the calculator, the trend follows. And when the trend changes, I know that the trend is changing, and that's the time I want to go short. And over here, I want to go long. And if you follow, when it's stabilized, at that time, when it's flat, I don't want to do any trade, because at that time, the analysis says, that we don't know which way it's going based on the chart. If we look at the, let's go here. So based on the technical analysis, when the moving average is flat, I don't know which way it's going, and at that time do not make any trade. So over here, this is a deadline, a dead zone. I can draw a here, let's draw this one. So over here, when the moving average has no activity, even though there is activity, but the moving average is sort of flat, and then it's not a good time to trade. Then it went upwards, so I know it's going up, and at that time I could have made a long position at that time, and then it's going up, and then it's going down, and you can see the trend is going. The moving average doesn't go with the price. It goes slowly, gradually, smoothly. It falls down and it levels up, it falls down again. So this is what the moving average is. Now when we look at this chart, we can also add the indicator for the parabolic SAR. So once again, we will go to our indicator chart and type in para, and now it's going to show you the parabolic SAR, stop and reverse, and you will see a bunch of dots over here, and this is what the calculation. So when we looked at this formula here, you wouldn't have to sit there and calculate all this. you can simply turn this indicator on your chart, and that way you can use that to predict which way the price is moving. Now, one thing to note is that the parabolic SAR and the trend line are correlated to each other. So what that means is that the trend is the biggest indicator, and sometimes you can see the dots and the trend line are on top of each other. So what that means is it's so much close that they're actually on top of each other, that they are so in line. But sometimes because of the nature of the formula for parabolic SAR is different, it is offline, and now it is in a different direction.